Well, we then know there's a bit of a European crisis, but life across the Atlantic in the US seems almost as stressful, not least because of European woes. Dr. Larry Meyer served on the Federal Reserve Board from 1996 until 2002, where he was acknowledged as an influential member of the Federal Open Market Committee. He's a senior advisor of Macroeconomic Advisors, a firm he co-founded in 1982. Dr. Meyer was in Sydney speaking to RBS clients about the outlook for the US, and I caught up with him earlier. Dr. Larry Meyer, welcome to the programme.
Good. Pleasure to be with you.
Well, let me start with the US Senate, which has just passed a bill that threatens sanctions on China unless it revalues its currency. Now, it's very unlikely to make law. What is the point?
Well, you certainly understand the concept of political positioning, of taking the position of American workers being unfairly treated and trying to make decisions in their behalf, and going after China in particular, which is viewed as today, given how high the unemployment rate is and how serious the job program is a natural target for congressional displeasure.
And I see this week that the Senate has effectively killed off President Obama's jobs bill. You do have over 9% unemployed. Is there a worry that there could be an escalation of this sort of rhetoric that could lead to a full-blown trade war?
Well, I doubt that it's going to come to that. It's sometimes hard to misjudge how misguided our politicians can be. But in today's world, with as many risks as there are, the last thing you want to do is generate more risk.
Well, overnight we got the latest FOMC minutes detailing the Federal Reserve's decision to go ahead with Operation Twist. That's buying long-term bonds and selling short-term bonds. Most analysts think now that the Fed will keep its powder dry and not go with another dollop of quantitative easing in November. Do you agree with this? And is the strategy the right one?
Well, I do agree. They've done something in successive meetings. Now, I must say the minutes coincided completely with our views of where the committee is, not to implement a decline in the IOR rate, that Operation Twist was a one-time movement and not going to be repeated. The QE3 is an available option, but not really on the table immediately, and that the big discussion is about what to do with communication, how to provide more information to the markets about the long-term objectives and how the committee is going to use those in terms of implementing policy in the short run. In a sense, what their reaction function is. And I think this is where the debate is. A lot of the things are very controversial, and we've said before this meeting that we expected communication to be the next option. We expected something in January.
I suppose the gamble here is that any stimulus should drive growth. The danger is that with no austerity and no recovery, that the Fed has fallen between two stools and could be heading towards the European situation.
Well, first of all, there's nothing that the U.S. Can do itself with respect to the European situation. The Fed policy today probably is less effective than it's been in the past, and they're running uphill. It's hard to ease enough to have enough impact on long-term rates to offset the decline in equity prices, appreciation of the dollar, and widening of credit spreads that's taking place as a result of the crisis in the euro area.
What's Operation Twist done for home mortgage interest rates? Because it was supposed to bring them down, I think.
Well, I think that it's much debated inside and outside the committee how effective the last several moves have been. Now, we believe each move has had an impact. QE2, maybe 20 basis points. Operation Twist, maybe 20 basis points on the 10-year rate. Some improvement in financial conditions, but relative to what they otherwise would have been. You don't see financial conditions improving because they haven't eased enough even to offset what's going on, as I said, in the euro area.
You're widely recognised as one of America's top economic forecasters. How do you see the road ahead for the global economy, and what's the biggest risk for the United States?
Well, I think there are two things. First of all, you can't understand the U.S. economy without appreciating the struggle and the challenge of mounting a sustainable recovery after a banking and financial crisis. Those headwinds are with us. They make it difficult to move into anything like a normal recovery following a recession, and they make it a struggle to get even to trend growth and to keep the unemployment rate from moving higher. Now, we're optimists. We believe that the economy has already returned to something close to trend, that it will continue to grow to trend going forward over the next year. And the good news is that things won't get worse in terms of labor market conditions, that the unemployment rate will be about where it is today and not worse. Okay, and that's today, I think, a somewhat optimistic view. The greatest risk to the economy is in the context of an economy struggling to keep its heads above the water. It faces the global risks, particularly associated with the euro crisis, that could easily push the global economy into a recession if we get the worst case outcome. And putting the economies of the globe on a more stable and sustainable recovery path is the task that we're looking for, knowing that we're getting little help and only damage perhaps from fiscal policy, and that we have very limited possibility for monetary policy. So this is probably more dangerous than the banking and financial crisis of 2008, because if we fall into recession, deflation risks will mount, and there may be no policy response, and we're all on our own.
Dr. Larry Meyer, on that wary note, I thank you.
Oh, and I'm an optimist, by the way. Let's leave smiling. I'm an optimist.
Nice to talk to you, sir.
Okay, bye-bye.